Good day. I'm Mark Woodworth, president of PKF Hospitality Research here in Atlanta, Georgia. It's about the 1st of April, and we'd like to thank you once again for taking a few minutes out of your day to hear of our current edition of Hotel Horizons Update. I'm very happy to be able to tell you why we've tripled our RevPAR outlook for 2012. Not really, it is April Fool's. But what I did want to do today was to share with you our current thinking based on our most recent forecast update. I had the good fortune once again this year to speak at the Hunter Investment Conference held here in Atlanta towards the end of the first quarter each year. Here we show a year ago at the Hunter Conference what our expectations were for 2011 and 2012. Based on actual data from Smith Travel Research for year-end 2011, you can see that overall occupancy was about a half a point better than we anticipated, and average daily rates played out pretty much as expected. The surprise and overall full demand recovery did lead to a more favorable 8.2% increase in RevPAR last year. In thinking about our view a year ago for 2012, as compared to our expectations today, you can see that our outlook for occupancy levels this year is literally the same. What is different is our expectations for rate growth are not quite as robust as what we were thinking in the first part of 2011. So why are our rate expectations not quite what they were a year ago? As we've been saying for the last year and a half now, if we think about what have been the main drivers of the demand recovery that we've seen over the past 2 years, it's been corporate profit growth, real personal income growth, and the fact that hotel room rates have been very, very low. Well, here we show the current forecast for corporate profit growth from Moody's Analytics. And as shown, the level of increase in corporate profit growth the last few years has been phenomenal. Their expectations going forward, while still positive, are not nearly as robust as what we have seen. Next, in considering their most recent forecast for real personal income growth for 2012, what we can see is there has been a slight downward revision from Moody's in terms of the overall level of increase they expect to see this year. The next factor that we take into consideration is what can we learn today from the Index of Leading Economic Indicators from the Conference Board. As shown here in this graphic, there is a clear relationship between changes in those economic indicators and change in overall lodging demand in the U.S. As we look at the far right side of this graph, it's very, very clear that the blue line has been in a clearly pronounced downward decline since the beginning of 2011, really almost a year ago. But fortunately, over the past few months, we've seen that indicator begin to tick back up. Considering that there is traditionally a 6 to 8 month lag between the change in the indicator and the change in both direction and magnitude of change in U.S. lodging demand, our interpretation of these data is that we should expect to see a slowdown in the rate of demand growth late in the second quarter of this year and through the third quarter of 2012. The last factor taken into our consideration is the fact that room rates, as shown here, relative to their previous peak, measured at the end of 2011, in the vast majority of markets, as well as for the U.S. as a whole, remain well below their historical peaks. As shown, the U.S. average was 5.4% below its previous peak. The good news is that average daily rates, as well as occupancies, based on our current forecast, are expected to increase very, very consistently as far out as we can see. Average daily rates are going to grow literally in all 50 markets that comprise our Hotel Horizons universe, and occupancy in all but a few are going to be growing as we move forward. Good news continues to be had in the industry, and we remain very, very optimistic for demand and profit growth throughout 2012 and beyond. Thanks once again for your time.